Discuss about introduction to accounts. So we are going to understand what its meaning and definition, who is the definition of company, essential specific company, kinds of company shares, its meaning, definition, types of shares, building dematerialization, issue of shares, feature, issue of shares, right shares, new shares, and retention. The debentures we have meaning, issue of debentures, issue and redemption of debentures, issue of debentures for capitation other than cash, issue of debentures as collateral securities, interest on debentures, commissions from interest purchase shares, this underwriting and underwriting. So let's try to understand, let's understand what essentially is ethical. The company is registered in the company from separate legal entity. The business, the person who starts the business, the person it is distinct from the members of the company. The owners are different and the business is different. They both have separate legal entity. Perpetual existence, whether the business, a person or the owner exist or do not exist, but the business will continue forever. Either it is unaffected, either by the death or the fact of any death, insanity, insolvency or anything, but the business or the company will continue forever. Transferability of shares. In public companies, the shares are freely transferable through stock exchanges without any contact or with or consent of the company concerned. And limited liability. When the liability of a member is limited to the extent of any unpaid amount on shares held by him or her in the company. Next is common sale. A separate legal entity independent of its members, the company, whenever enters into contracts, uses a common sale. And delegated management. So these are the characteristics of the company. Next, we have kinds of companies. Under the kinds of companies, they are categorized on the basis of incorporation, on the basis of liability of members, on the basis of number of members, control, ownership, nationality, and other miscellaneous categories. On the basis of incorporation, we have chartered company, statutory company, registered company. So a chartered company means the companies which are made by the charter of the king or queen of that particular country is called chartered company. And such companies may be still prevalent in some countries like some countries in the world like England, where they have still East India Company of England, BBC, British Broadcasting Corporation, the Bank of England. These are the examples of chartered companies. The next comes statutory company. These companies are being established by the special act of legislation, which incorporates the company with the objective of carrying out business, and which are in the general interest of the nation or state as a whole, or come called statutory company like RBI, Reserve Bank of India, Unit Trust of India, Life Insurance Corporation of India. These are the examples of statutory company. Next is registered company. A company formed and incorporated under the Companies Act 2013 or any other previous companies law, it is registered as called as registered company of India. Examples we have Tata's, Birla, Mahindra, Reliance, etc. This all comes under the registered company. These are all the basis on the basis of incorporation. The next is basis on the basis of liability of member, like companies limited by shares. Means here a company which has share capital and the liability of each member of the company is limited by the memorandum to the extent of face value of share, then it comes as company limited by shares. The next is company limited by guarantee. This type of company may or may not have a share capital, but each member promises to pay a fixed sum of money specified in the memorandum of association. Next is unlimited company. A company which does not limit the liability of shareholders, members is known as unlimited company. In other words, a company whose member shareholders are fully liable for the debts incurred by the company like partners of partnership firms. Next, we have on the basis of number of members. On the basis of number of members, we have private company and a public company. Even one person company. Next, we have on the basis of control. The control on the base of control, we have holding company and subsidiary company. And on the base of ownership, on the base of ownership, we have government companies and non-government companies. On the base of nationality or domicile, domestic company, foreign company, multinational companies, and other miscellaneous categories such as associate company, banking company, and small company and body corporate. Next, we talk about the shares. What is share? Share is in any company represents the ownership, membership of the holders. It's nothing but the capital which is invested by the owner at the starting of the business. The total capital cannot be invested by a single person, which is divided into small units. The capital is divided into small units, and each unit we call it as capital. And each unit we call it as capital. Each unit we call it as capital. And the each unit of the capital is divided into small unit, and each unit we call it as share. The capital is divided into small units, and each unit we call it as share. And the person who purchased the share, call them as shareholder. The person who holds the share, we call them as shareholder. Now we have types of shares. Shares, equity or ordinary shares. Preference shares means at the winding or at the liquidation of the company. At the winding or at the liquidation of the company. At the winding or liquidation of the company, the preference is given to the preference shareholders only. And at the payment of the dividend also, the first will be paid to the preference shareholders. But whereas equity shareholders, if any profit is left over even after paying the payment to the uh, preference shareholders, if anything is left over, then it will pay to the equity shareholders. Even at the time of liquidation, they will be paid only when anything is left over in the business, any amount. Next is dematerialization. Means nothing but demat. Means dematerializing the share certificates. Like you share me, they give some paper document. Now it become an online. It's only soft copy. Electrically, they are depositing. Next, issue of shares. Why? Because the capital which is required to that particular company, they may not accumulate it. To get that capital, they depend upon the public and they issue the prospects. Whenever they issue shares, they will issue shares at the three value, that is share price value, or it is called as at par, shares issued at par. Shares issued at par means they are issued, for example, the share value is 10 rupees, they issued at 10 rupees only. Shares issued at premium means if the shares are value is 10 rupees but issued at 20 rupees means issuing shares more than its face value. It is called issued at premium. Next is issued at discount. Means here we are issuing the shares which are, for example, the share value is 10 rupees, but you are issuing at 7 rupees, then it is shares issued at discount. Sometimes issue of shares for consideration other than cash. So they will issue the shares even they are not receiving any cash, but they may receive some assets like building, some furniture, some plant and machinery. So anything you are receiving instead of cash, if you are receiving the other than cash in the form of kind, that also comes under the issues of shares for condition other than cash. Next is forfeiture and reissue of shares. Forfeiture of shares means the amount which has to be paid by the shareholder, but the shareholder could not pay the share amount on time. In that case, that particular shares will be forfeited. Forfeited means cancelled. There is a chance of cancellation of shares if you are not paying your due amount on time. Next is reissue of shares. So the shares which are been cancelled, that will be reissued again to some other shareholder, that is called reissue of shares. Next is bonus shares. Bonus shares are the shares that are allotted to the existing equity shareholder without any consideration, means without taking any amount from them. We are issuing shares to the existing shareholder without taking any consideration, either in the form of cash or in the form of kind. They are issued to capitalize profits of the company. So what they'll do, instead of they think that instead of giving profit to the shareholders, it's better issue the shares that may be benefited to the shareholders and also benefited to the organization also. Shares may be issued from out of free reserves, securities premium account, capital redemption reserve account. The next one is preference shares. So preference shares are also commonly known as preferred stock, and they're defined as the shares that allow an investor to own a stake at the issuing company with a condition that whenever the company decides to pay dividends or even repayment of capital also, the holders of the preference shares will be given the first to be paid. Priority will be given to the preference shareholders only. And the type of preference shareholders are cumulative preference shares, non-cumulative preference shares, participating preference shares, non-participating preference shares, convertible preference shares, non-convertible preference shares, redeemable preference shares, and irredeemable preference shares. In case of these shares, any cumulative preference shares means any shortfall in the payment of dividend, that amount will be get accumulated and that will be repaid to that preference shareholders whenever there is a sufficient and enough profits are with the organization. Next one is debentures. Debentures is nothing but an of debt, an acknowledgement of debt to which we on base of security, unsecured debentures, or secured debentures on the basis of convertible debentures, non-convertible debentures, issue and redemption of debentures. Even the debentures are issued for cash or other than cash, or issued for security also. So whenever they winding the organization, at the time first debenture holder goes to the preference shareholders. The next topic is company final accounts. So this is format of balance sheet as per Companies Act 2013. same balance sheet where we used to write liabilities amount, assets amount, the same thing, but they made it in vertical form rather than it's in horizontal form. Instead of writing liabilities and assets, they made it in one side and the other side two columns. Just look at the equity and liabilities. Equity and liabilities is nothing but all the liabilities, whatever we write in the balance sheet, we take under equity and liabilities. But they're divided it. Because if you remember the liabilities, we write capital, we write net profit, drawings, bills payable, sundry creditors, outstanding expenses. So these all we used to write under the liability side. That only we're bringing under some different names and different heads. Okay. So liability is only divided as equity and liabilities. Liability is only divided as equity and liabilities. Under that we have shareholders fund. Under that we have share capital, reserves and surplus, money against share warrants. And again share application money pending allotment and non-current liabilities like bond, debentures or any long-term loans that are being taken. And next one is current liabilities. Under that you have short-term borrowings, trade payables, other current liabilities and short-term provisions. And this all together we call it as total liabilities of total. Next is assets. Under assets you have non-current assets. Under that we have fixed assets. Again under fixed assets, tangible assets, intangible assets, capital work in progress. Intangible assets under development. And we have non-current investments, assessments, and other asset investments, inventories, trade payables, that is trade receivables, cash and cash equivalents, short-term loans and advances. So this is the form financial statement of any company. So again here they given this capital means what all will come under that. Capital means all the capital reserves and surplus. So reserves and surplus means what will come under that. And reserves and surplus we have capital reserve, capital redemption reserve, securities premium reserve, revaluation reserve, share options, outstanding amount, and other reserves. And long-term borrowings we have long-term borrowings maybe include debentures or bonds, term loans from banks and from other parties also. And other long-term liabilities we have trade payables and others. Long-term provision we have provision for employee benefits and others. We have loan payable on demand from banks and from other parties. And if you look at here, short-term borrowings and other current liabilities. Other current liabilities here we have unpaid dividends, income received in advance, income received in advance, income, interest accrued. So these are the current liabilities. And short-term provisions, if you look at here, provision for employee benefits and other specified. And when you look at tangible assets under asset side, here we have land, buildings, plant and equipment, furniture and fixtures, office equipment, or any other assets. And intangible assets, we have goodwill, brands, trademarks, computer software, mining rights, copyrights, patents, licenses, and franchises. Non-current investments, we have investment property, investment in equity instruments, investments in preference shares, investment in government, or trust securities, investments in debentures or bonds, investments in mutual funds, investments in partnership firms, long-term loans and advances. Under this, we have capital advances, security deposits, loans and advances, secured or unsecured, other non-current assets, and current investments. We have investments in equity instruments, investments in preference shares, investments in government or trust securities, investment in debentures or bonds, mutual funds, partnership firms, inventories. Inventory means stock. Stock may be the raw material, work in progress, finished goods, stock in trade, stores and space, loose tools, and trade receivables. We have again trade receivables subclassified into secured, unsecured, and doubtful. Cash and cash equivalents. Anything which is equivalent to the cash and cash equivalents like cash at bank, cash in hand. Yes, that's all are cash and cash equivalents. And any short-term investments which can be easily converted into cash in a very short period. That also comes under cash and cash equivalents. Next is short-term loans and advances. Can just look at this profit and profit and loss. Here earlier we profit loss account. Now this is as per company's act it is, that is profit and loss. So here we have this is the format. There is trading account and profit and loss account. But here we will study in different. Instead of studying as trading and profit and loss account, here we study it as statement of profit and loss. So revenue from operations and other income. Revenue from operations means nothing but whatever the sales we are doing, that is our revenue. Any other income that will be written over there. From that we deduct the expenses, that is cost of material consumed, means nothing but raw material or opening stock purchases and whatever the stock is left over and all any other direct expenses. If you add that, you'll get total expenses. So, and the difference between the total revenue means whatever income you are getting from the sale of sales and from the purchases. If you deduct it, you'll get profit before exceptional items. Next, we have exceptional items. Next, profit before you will have profit before tax. Tax, if you deduct, you'll get profit after tax. And whatever the profit is left over from that profit, any earnings per equity share, if any profit, what are the profits that are left over to the owners of that company. What are the things we are doing? That all will come under cost, interest expense, borrowing expense, comes under finance cost, and incomes like interest income, dividend income, net gain or loss on sale of investments. Dividend is nothing but whatever the profit that has been earned and the profit paid to shareholders is dividend. So these are few illustrations given over us here for us to calculate. So this is the profit and loss statement they given us. The given revenue from operations, other income, cost of materials consumed, changes in inventory, benefit expenses, finance cost, depreciation and amortization expenses, other expenses, corporate income tax rate at the rate 35%. Revenue from operation directly given 52. Other income is also given. When you add, you get total revenue. Next is the expenses, cost of materials consumed, change in inventories, employee benefit expenses, finance cost, depreciation and amortization, and other. When you add all this, you get total expenses. Profit before exceptional and extraordinary items, you'll get that. That is 3 minus 4. And here we don't have any exceptional items. So again, profit before extraordinary items. Again, we don't have any extraordinary items, so profit before tax and tax is given, and the tax is given at 35%. So 35% comes to 4.97. If we deduct that, we will get it profit after tax. Similarly, with respect to the balance sheet, that is statement of balance sheet is also prepared like that only. And then block 3, that is cost accounting. So under cost accounting, we study about the cost accounting and part, marginal costing and decision techniques, standard costing and budgeting and budgetary control. So first we try to understand costing and introduction. What is cost accounting and cost accounting? So costing may be defined, actually cost means the expenditure input to produce any product is called cost, and costing is nothing but it's the technique and process of ascertaining cost is called as costing. Accounting is nothing but deals with collection, analysis of relevant data, cost data for interpretation and presentation of various problems of management. And it may be regarded as a specialized branch of accounting, which involves classification, accumulation, assignment, and cost control of cost. Then what is cost accountancy? So basically application of cost and cost accounting principles. Classifications, we have historical and predetermined cost, material, labor and overhead cost, direct and indirect cost, product and period cost, fixed cost, variable cost, semi-variable cost, manufacturing cost, administrative, selling cost, pre-production cost, capital and revenue cost, controllable and non-controllable cost, marginal, uniform and replacement cost, opportunity cost, sunk cost, differential cost, joint cost. So here we have capital and revenue cost, controllable and non-controllable cost, opportunity cost, sunk cost, differential cost, joint cost, common cost, imputed cost, out of marginal cost, uniform cost, and replacement cost, conversion cost, traceable cost, normal cost, avoidable cost, unavoidable cost, and total cost. So what is historical cost? The cost which are already ascertained after they are incurred are called historical cost. And predetermined cost means the costs which are estimated that in future we may achieve it or we may reach or we may expect this cost, that is called predetermined or estimated cost. Even standard cost, this method is involved mentioning some standards for each element of cost and each product. Classification on the basis of nature of elements. Material, direct material, we have indirect labor, indirect labor. Well, expense also we have direct expense and indirect expenses. Just to repeat, how do we ascertain cost? The cost includes all these elements. To ascertain cost of any product, it involves all these elements. These are elements of cost. These are called elements of cost. So for any product, what we said, for cost is nothing but the expenditure incurred to produce a product, we call it as cost. So for any product, we require material. Material may be direct material or indirect labor, material. Even labor, we require direct labor or indirect labor. Other expenses, we have direct expense and other indirect expenses. When you add all this direct material, direct labor and direct expenses, that we call it as prime cost. So prime cost is nothing but direct material, direct labor, plus direct expenses. When you add these three, you'll get prime cost. You'll get prime cost. When you'll get prime cost, when we add direct material, direct labor, and direct expenses. These two will, when you put these three together, that we call it as prime cost. That we call it as prime cost. Now, if you take indirect material, indirect labor, and indirect expenses, when you put these three together, we call them as overheads. When you put indirect material, indirect labor, and indirect expenses, when you keep these three together, we call them as overheads. What do we call? We call them as overheads. Again, overheads are of four. That is manufacturing overheads or production overhead, administration overhead, selling overheads, and distribution overheads. Manufacturing overhead, administration overhead, selling overhead, and distribution overhead. So here, let me explain this again. Administration overhead, the expenses which are related to the office, like salaries, office rent, telephone charges, postage, telephone, telegraph, stationery. The expenses which are related to the office are called administration expenses or office expenses or office overhead, we call administration overhead or office overhead. Selling overheads, the expenses which are related to the sales, like salesman commission, salesman traveling commission. Yes, that all comes under advertising, advertisement expenses, that all comes under selling. Next comes distribution overhead. Like for before distribution, we need some storage go down, expenses go down, rent, insurance of that particular go down, salary of that storekeeper, that comes under the distribution overhead. When you add all this together, you get cost of product, cost per unit. You get cost per unit. Distinction between cost accounting and financial accounting. So financial accounting is prepared at the end of the financial year to know the financial position of the organization. And cost accounting is prepared to find out what is the cost control, what are the scientific methods we are following to reduce the cost, to have the cost control and cost reduction. Financial accounting is more attached to the government like creditors, investors, and owners. Whereas cost accounting, it is an internal reporting system for organization, own management for decision making. Whereas financial accounting data is historical in nature, whereas cost accounting is futuristic approach. And in financial accounting, the major emphasis is on cost classification, such as type of transactions like salaries, repairs, insurance, stores. Whereas cost accounting, here we talk about the product, process, its activities, its control that we talk about. And in financial accounting, only those transactions are recorded which are expressed in monetary terms. And cost accounting uses both monetary as well as quantitative information. Financial accounting aims at presenting true and fair view, whereas cost accounting computing true and fair view of the cost of production services. Financial accounts are subject to statutory audit to verify whether they disclose are true, fair, or not, whereas cost accounts are subject to cost audit. Next, costing methods and techniques. Methods of costing: job costing, batch costing, process costing, operating costing, and corporate costing. So these are the different types of costing methods are followed based on the type of production they are doing. Type of production they are doing. Job costing is specifically mentioned for this particular job. When it's done, then it's closed. Next, batch costing. Batch costing is specifically used in washing machines. Means they at a time they'll produce these many things: televisions, air conditioners, washing machines. They'll produce in the form of batches. Process costing: to produce one product, it has to pass different stages. That is called process costing. Like sugar. Sugar is not can not be produced in one stage from sugar cane to jaggery, and then again some sub stages they are available to become a sugar. Similarly, with respect to chemicals, also they go undergo different process. Next, operating cost. Operating cost is specifically used in hospitals, power generating units, or transportation sector. Contract cost is specially used in the constructions of bridges, commercial complex, residential buildings, or highways, etc. Techniques of costing. Here we have marginal costing, standard costing, budget and budgetary control. Next is marginal costing and decision making and decision techniques. Marginal is nothing but in addition. Anything, for example, you are producing 10 products. Now you want to produce 12 products, means increasing two products. So when you're increasing the production of extra two products, what is the cost that is going to incur? That is called marginal cost. Means marginal cost means the amount at any given volume of output by which aggregate costs are changed if the volume of output is increased or decreased by 1 unit. That's what. For example, if you are using 10 units, you are producing 10 chalk pieces, you are producing. Now you want to produce 15 chalk pieces. Means what happened? 15, 5 are increased. To produce that extra 5 chalk pieces, what is the cost we are incurring? That is called marginal. So for any increased number of production, what is the cost of production we are going to involve? That is called marginal cost. For example, instead of 10, you want to produce 5. So when you're decreasing, so what is the cost? Simultaneously, along with the production, what is the cost we are incurring? That is called marginal cost. So marginal cost is equal to total variable cost. So total variable means direct material, direct labor, which are changing. It changes along with the production. The cost which is changing along with the production, that we call it as marginal cost. So here we have, for example, direct material, direct labor, direct expenses, plus all other variable overheads which are increasing. For example, to produce one bench, we require material, one log of wood maybe. We may require one labor, or we have some direct expense and other expenses. For example, if you want to produce two benches, you require two logs, two labors, and an extra expenditure. Similar, three benches, three logs, three labor. So what is happening? Along with the production, even the expenses are also increasing. That is called marginal. Marginal cost is equal to total variable cost. What is total variable cost? Direct material, direct labor, direct expenses plus variable overheads. When you add all these three together, we call it as total variable cost. TMC is equal to TVC. Total marginal cost is equal to total variable cost. Or even we can write TMC is equal to total marginal cost is equal to total cost minus fixed cost. Total cost minus fixed cost. This is the format of calculating marginal costing. You can just look at your income statement under marginal cost. Income statement under marginal costing. So here sales minus variable cost, whatever balance you get, that we call it as contribution. Sales minus variable cost, and the difference we call it as contribution. From that, if you deduct less variable fixed cost, from that, if you are deducting fixed cost, the difference we get, we call it as profit. The difference we get, we call it as profit. This is a statement how we prepare and how we attain the profit under marginal costing. Under marginal costing. Under marginal costing, how do we attain profit? We attain profit by sales minus variable cost. If you deduct it, you'll get contribution. And from that, if you deduct fixed cost, you'll get profit. You'll get profit. So here we can do this. A company is manufacturing three products, A, B, and C. A, B, and C. The cost of their manufacture are as follows. Direct material is given, direct labor, selling price, and output is given. Of three products, they are having three different products. The total overheads are 6,000, out of which 3,000 are fixed and the rest are variable. So the total overheads is 6,000 expenditure, in which 3,000 is fixed cost and the remaining are variable. So remaining 3,000 is variable. It is decided to apportion these costs over different products in the ratio of output. So the ratio of output is they are producing 1,000 units. 1,000 units means it's equal. You can take 1 is to 1 is to 1 or equally 3 should be divided. 1 is to 1 is to 1 is to 1. Now, compute the amount of profit under marginal and traditional costing system in case the units sold of A, B, and C are 900 each. So, how many units they are producing? 1,000. But how many they are selling? They are selling 900 units only. Now, look at here A, B, C under absorption costing. So, they've taken material, labor, and overhead. If 1,000 is now 1,000 into 3, 1,000 into 2, and 1,000 into material labor. And variable is how much? As per the ratio, so it is 1,000. 3,000 are 1,000, 1,000, 1,000. Similarly for B also 4 into 1,000, 3 into 1,000 and 1,000. Similar. And this is called total marginal cost for A is 6,000, B is 8,000 and C is 10,000. Add fixed overhead. Fixed overhead is how much? 3,000. So again for three of them 1,000, 1,000. Less closing stock. What is telling? So if you just look at here, A is producing 2700. How they found it? Why? Because they're selling at 10 rupees. If you can just look at here, they are selling it at 10 rupees. A is selling at 10 rupees, B is 15 rupees, C is 20. Yes? How many units they are selling? 900. So 9 into 100, 9,000. 13,500 and 18,000. So how many are left over? 1,000 are left over. Yes? So less closing stock is 700, 900 and 1100. So these formulas have to be understood. These formulas are made out of that marginal costing statement only. Now nothing but simple sales minus variable cost, you will get contribution minus fixed cost, you will get profit. This only they made into formula. This statement only they made in formula. Contribution is equal, how we are getting contribution? Fixed cost plus profit. If you add these two also, if you go back reverse, you'll get contribution. Contribution is equal to fixed cost is also accepted. When it is at loss, contribution is fixed cost minus loss. If you are getting profit, we are adding. If you get loss, we deduct it. Contribution, how we got? Sales minus variable cost. Thank you all. Remaining, we continue it in the next class.